The Get Rich Slow Club podcast is a collaboration between Tash Etschmann from Tash Invests and Ana Kresina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us. Erica Hall is an ESG analyst for Morningstar, has her master's in financial planning, and has over 20 years experience in the financial sector. We talked to Erica about ESG investing, greenwashing, and what to look for if you want to invest ethically and whether it's worth it.
Hi everyone, welcome back. Today we'll be talking to Erica Hall from Morningstar, a financial services rating agency, about ESG investing, which is often referred to as ethical investing. But before we get started, let's share our money wins and our money losses for the week. Erica, would you like to start?
Oh, okay, fantastic. Well, I guess in terms of money losses, I had a friend who was a stockbroker who convinced me that Channel 10 shares would be a fabulous place to invest. And I didn't do any of my research, took him at face value and bought those shares, which have since delisted and they just continued to plummet.
Oh, no.
So, yeah, I think the learning there is, do your research, diversify, and it's not a good idea to just take advice at face value. You've got to own those decisions. Gosh, in terms of money wins, I think, honestly, for me, it's just being in diversified investments, and I'm probably more in relation to my superannuation, and I've gone into a high growth strategy, which suits me because I have a long time before I retire. And I have actually invested sustainably because I really do believe in the benefits of sustainable investments. And that's been, a pretty good place to be. Although the last 12 months have been somewhat challenging and I have seen my investments drop, but I'm still really happy with that investment over the long term. It's produced amazing results for me, and I feel really confident because I'm aligned to my values as well. My investments are aligned to my values.
That's amazing. I'm really excited to get a little bit more into that a bit later. Anna, do you have a money win or a money loss for us today?
Yeah, mine is not as exciting as yours, Erica. Mine is just, I was going to share my weekly one. I got a $6 shelf from the local kids garage sale around the corner from my place. So I thought that was a score because I needed to buy a shelf for my office. And I'm sure that they read the Barefoot Investor book for the kids because they were out there hustling. So I got my $6 shelf. That was my win. I don't really have a loss for this week. So that's the one I'm going to share.
It's a good looking shelf for anyone who's watching on YouTube or the video. It looks great. My money loss of the week was I lost my AirPods, which was a little bit sad, but I bought new ones and I got some cash back as well. So that was a little bit of a money win in there, thankfully.
Awesome. So let's get started. The word ethical has a lot of connotations and means different things to different people. There's not going to be one ESG ETF that everyone agrees is ethical. We've covered what ETFs means in previous episodes, which is exchange traded funds. But Erica, maybe you can tell us, what does ESG stand for?
Yeah, sure. So ESG stands for environmental, social and governance investing. And it is a bit of an umbrella term, and it's all encompassing and can mean different things to different people. And I think when you think about ESG investing, you can be investing to sort of mitigate risk, or you can actually be investing to improve the world and invest for impact. So make a positive difference with your investments. And I think typically in the past, it's all been about mitigating risk. So financially and material risk, climate change is a major thematic in ESG investing, and Australians are really behind climate change. And I think because we have been directly impacted, we have seen bushfires, we have seen floods, we have seen extreme weather patterns. And so, as a result, we've got a new government in place and they're making a lot of changes from a legislative perspective. And so we're now signed up to the Paris Agreement, which is all about limiting greenhouse gas emissions and, I guess trying to limit climate change and trying to limit temperature rises through reduction of greenhouse gas emissions. The other thing that we haven't had in place is regulation and disclosure in terms of what ESG means. And so that can be really challenging because how do you make comparisons between different funds that can sound fabulous from an ESG perspective, but because there is no regulation in place, are they actually delivering on what they say? And I think that then leads into some of the things that are happening from a greenwashing perspective, and regulators looking really closely at fund claims. And I guess what we are seeing is a lot of money flowing into ESG strategies. And so from a regulator's perspective, they want to know that capital is being allocated efficiently. So as an investor, if you want to invest aligned to your values and you want to invest in an ESG manner, then you want to be sure that the strategy that you've invested into is delivering to that. And without the regulation, it can be a little bit tricky because the marketing materials can sound amazing, but when you dig beneath the surface, maybe it's not quite living up to the claims that they are saying that they can deliver to.
Yeah. It's hard to get that trust with everyone. Like I know Vanguard recently got in trouble for greenwashing, and you don't expect that from someone like Vanguard. So it's hard to build up that trust with everyone.
Yeah, and look, that one was a little bit unfortunate because it was a bit of a technicality. So obviously index manager, they benchmarked to particular indexes. They had an ESG index that they were benchmarking to. That particular benchmark provider had two very similar benchmarks, one that obviously didn't have tobacco and then from a production perspective, and one that also didn't have revenue from tobacco sales, and they just pulled out the wrong index in the PDS, I think it was. Mm-hmm. And the irony of that one was there was no material impact to investors because the revenue component wasn't hit. And so even if they had been trying to track to that benchmark, the underlying holdings would have been the same. But agree, it shakes confidence because it is easy to make mistakes. And,
it's hard. It's just hard as an everyday investor to know what to look for in these kind of things as well when you're getting started in the world of ESG investing. But going back to what actually ESG is, I know when I first started, I didn't have any idea what governance meant because I thought ESG was just ethical. I didn't realize it was like environment, social, and governance.
Yeah.
Can you explain a little bit more about what that means and how that applies?
Yeah, for sure. So governance is really around, I guess, the ethics of a business and what they're doing to sort of make sure that they're, being good corporate citizens. And also it covers things like board composition and diversity and inclusion. So it's quite far-reaching. Remuneration as well. Yeah.
Yeah, awesome.
I know we talked a little bit about the benchmarking in an index, but we haven't really talked about that on the podcast. So I'm wondering if we can actually just take a step back and be like, what is ESG investing? How does that work? What does it track? How does that fit in the whole ecosystem of investing? Because I don't think we've discussed that on the podcast yet.
Yeah, so ESG investing is when you're making your investment decisions, you're taking into account environmental and social and governance issues. And you're wanting to typically, tilt the portfolio to these qualities. But there are many different ways that you can invest with deference to ESG. So ESG investing can mean many things. As I said, negative products. So it might be you just don't want to be exposed to these sort of negative product involvements. There's 14 of them that we capture from a research perspective. And so tobacco is the most excluded product in ESG investing in Australia. And it is really interesting actually because the exclusions differ from country to country. So in Australia, you might find it surprising, but it's tobacco, it's alcohol, it's gambling, and fossil fuels is up there as well. And actually, adult entertainment was one of the other ones that we don't like in our products. But that's not the case overseas.
Elsewhere.
They've got different exclusions. So it is really interesting that it is regionally specific. So that's sort of the most basic is the product exclusions. And then you've got investing for impact. So it might be investing in renewable, energy products, or taking into account like electric vehicles, because you can see that where the future's headed is that we're going to be looking for like a low carbon environment going forward. We've had 194 nations sign up to the Paris Accord. And so as a result of that, fossil fuels have to be phased out over time. And so who are going to be the beneficiaries of this low carbon economy? And so you've got a number of funds that will invest into those industries that they think can really make a difference and will actually financially benefit from the transition to a low carbon economy.
Very exciting that we're moving forward with that. Can you give us a bit of an overview of some of those funds or some of the ESG ETFs out there?
Yeah, so I had a look actually, and so we've got 300, I think it was 301 ETFs in our database, but of those, 45 are what we tag sustainable, and we're really rigorous in terms of what we consider sustainable investments as well. So, there might be some argument that we're being a little bit too harsh. And so the main providers of the ESG ETFs, not surprisingly, because ETFs tend to be passive, but not always. You can actually have actively managed ETFs. So they're basically exchange-traded managed funds. So it's actively managed funds that are available on the Australian Stock Exchange for ease of transaction. You might want to invest that way. But, basically Beta Shares, State Street, Vanguard and BlackRock are the biggest sort of providers of ESG solutions. And so, there's a range of different options. So Beta Shares in particular has a lot of really niche, really specific ESG options available to investors, whereas the other large players, State Street, Vanguard, BlackRock, they tend to have more broad base. So it might be ESG leaders, it might be a balanced offer with, so you'll have, a mix of fixed interest and equities, but all sort of tilting towards better ESG qualities. And I think the methodology differs depending on what it is their objective is. So from an investor perspective, I think it is really important to look at the underlying objective of the fund and see what it is they're trying to deliver to make sure that it's aligned with what you're wanting to invest into.
I think for a lot of new investors who are interested in, ethically investing, ESGs are definitely a great option for them. But it gets so overwhelming, right? Like you just named a couple different providers. Where do you start, So are there any ESG ETFs within Australia or have also international exposure that are maybe worth considering? And can you talk a little bit about that? What someone would want to look for in those if they're looking to invest?
Yeah, so I have to be a bit careful because I can't offer advice as such, but I can certainly point out a few things that you might want to look at. So when you look at the ETFs that are available, most of them are available in equities. And I guess that's not surprising. They're listed entities. There's been a lot more data collected from an ESG perspective on listed equities. There's a lot more transparency. So, we can actually do a great ESG assessment on listed equities. So when I was looking at it, I found 5 ESG ETFs that were diversified options, 3 that were fixed interest options, and then all the rest, 37, were equity options. So 80% of the options available to investors are equities, number one. Look, I think the great thing about the ETFs are they are diversified. So that's great. So, back to my example of my Channel 10 share, my one stock, it didn't do so well. So, not diversified. Great. The best thing you can do as an investor is to diversify. It's the one thing you can do to mitigate your risk, because if you've got one, if I had a basket of shares and, Channel 10 was one of them in the basket of shares, maybe all the other ones would have done really well. Hopefully Channel 10 didn't do so well, but overall I'm okay. Whereas you've got all your eggs in one basket, it's risky. Yep, you can shoot the lights out, you can get really lucky, but, you could have the experience like I had and you can pretty much lose a lot. So I
feel like so many people have had that experience.
Yeah.
I hear that story all the time.
Yeah. So look, I think that's a really, pertinent point with the different ETFs that are available, is they do tend to be diversified. I think the other thing you need to look at is, the trading volumes of the ETFs. So you want ones that are quite liquid and that there's a lot of people investing into them, because that will help with the cost of trading those stocks. So the buy-sell spread will be tight, and so therefore you should be getting a good price when you're entering and exiting the ETF. If it's not liquid and the trading volumes are low, you'll find there'll be a wider buy-sell spread, and you might actually end up paying a premium to get in and out of the basket of stocks.
What would you say is like a low trading volume or a high trading volume that people should look out for?
Well, I mean, I was sort of looking at this from, like in terms of who has the highest average volume in the last 3 months. I found like Beta Shares Global Sustainable Leaders ETF had a really strong average daily volume, and that was 228 million.
Was that ETHI? ETHI?
Yeah, it is ETHI, ETHI, that's correct. So I think like one thing you could use as a proxy is you could have a look at the size of the fund. So typically the larger sized ETFs are ones that are likely to have more average trading volume.
Do you have a ballpark number for what is like a large fund?
Well, again,
I know it all depends.
Yeah,
when
it
I'm
does
looking
depend.
At stuff, I'm like, oh, it's a few million. That seems large, but is it large?
Yeah, I think you'd probably wanting to look at around that sort of 500 million and above. So again, yeah, if I look at it, the largest ETF in the Australian market in our database, so keep in mind we don't necessarily have everything, but I'm pretty sure we do have the bigger and more reputable ones, is BetaShares Global Sustainable Leaders ETF. And that's at 2.4 billion in size.
Oh, wow.
And it did have the largest average trading volume. And it's actually got at a reasonable fee. And so that's
what
the
would you say is the reasonable fee? Sorry.
So that's at it's a little over 0.5%. So it's 59 basis points. So 0.59%. Now, it's not the cheapest by far. Like the cheapest actually, I was looking at this was actually, let me just refer to my notes here. I know it was BlackRock. They had a couple at 9 basis points, which is pretty keen. Yeah. And so, again, they're passive funds. They track to the benchmark. When you're looking at passive funds, you want to look at those ETFs that can actually track really closely to the benchmark. And so there's, because tracking error is not your friend when you're investing passively, because if you're actually not tracking close to the benchmark, then you may not deliver returns in line with the benchmark. And so that's, great hygiene when you're investing passively.
I hadn't even heard of the BlackRock ones. Like I think the ethical ETFs I've heard of are some of the Vanguard ones, BetaShares and VanEck, but I haven't heard of the BlackRock ones.
So BlackRock, they call them themselves iShares when it comes to ETFs. So you might have heard of iShares, and that's
I've heard of
actually
iShares, but not their. What are their ethical ETFs? I haven't seen them marketed really.
Yep. Okay. Let me just pull that up for you. So iShares Core MSCI World Ex Australia ESG Leaders ETF. It's a mouthful, otherwise known as IWLD.
Yeah, interesting. I haven't heard of that one.
Yeah, and it's quite large. It's got 615 million in totality. There's another one, which is the iShares Core MSCI World Ex Australia ESG, which is called and this is the hedge version, I think, IHWL. And then there's a Core MSCI Australia ESG Leaders, which is the IESG. And then there's a Global Aggregate Bond, which is, there's very few, as we said, very few bond options available. So that's quite a sizable one. I think it's the second largest fixed interest one in the cohort, and that's called AESG.
Awesome.
So, they've got quite a few, but they had the lowest, fees available.
So there were a couple of things that you mentioned. You said diversification, seeing how large the fund is, seeing what the fees are as well. We talked a little bit about passive and active. Can you talk a little bit about that and what's better when it comes to ESG investing? Is there a better or of the two?
Yeah, look, that is a very controversial question. So I always feel like you've got two camps, those that are just really pro passive and really pro-active, and there doesn't seem to be a lot of middle ground. Honestly, I think there's place for both. So I guess with a passive, what do you get? You're getting really great diversification because you're matching a benchmark. So the benchmark is usually very well diversified in terms of underlying holdings, geographically, industries, sector, etc. So fabulous, and you're getting it at a low cost. And the whole premise behind it is, it's really hard to beat the market. So actually capturing the market return is not a bad place to be. And so it gives you a little bit more certainty as long as that tracking error is in check. You basically know it's going to meet the market. So whatever the market's doing, whatever the underlying benchmark's doing, that's what your ETF should be doing. With active, what you're trying to do is actually beat the market. And so your portfolio might look nothing like your underlying performance benchmark. It might have concentrated positions. They'll be skewing the portfolio into sort of industries or stocks that they think are going to perform better than average. And sometimes they get it right and sometimes they get it wrong. And there's definitely different capability sets. And so not all managers are the same. So some managers are better than others. But, of course, again, with an active approach, it comes at a cost as well. So not surprisingly, when I had a little look at the data, the 5 most expensive ETFs were all active exchange, traded managed funds. And because, there's arguably a lot more work that has to go into making active decisions. You've got to do all your analysis, and that costs time and money.
Is the strategy for ESG investing, like if you want to be active, just literally to beat the benchmark, or is there something else that comes under ESG that someone would choose active?
Yeah, trying to actively pick more sustainable stocks.
Yeah,
or something like
that. Is that a thing?
I think that's a really good question, actually, because ultimately, yes, when you're talking about ESG investing, you're investing to
make
typically,
money.
Well, you're investing to change the world, to make better choices.
I was going to say the other thing in terms of, you're actually wanting to invest in those companies that are going to be, around for the long term, and they're actually going to be sort of sustainable in terms of, they're going to continue to exist because their business model is aligned to this thematic that we're seeing, and this growing thematic that we should be investing sustainably.
The sustainability thing, but like the company being sustainable. But sometimes when I think about sustainable, I think of it like more as an environment thing, like viewing those as two separate things.
And that's where it can get confusing as well.
Yeah.
But and I think it really can mean both. But I think ultimately, investors want a return. So the return really matters as well. So you want both. So when you're investing sustainably, you want to be investing in companies that are doing the right thing, that are going to be around for the long term, that, can see that sort of the trend that's occurring and are positioning their businesses for success. And then theoretically, given that, they should also perform well in the long term. But the issue is when you're investing in ESG ETFs is that you've got to expect that they're going to behave differently to the broader market because they are taking into account the ESG components. And so I think the last 12 months has been a great example of this, where fossil fuel companies did extraordinarily well because of the conflict in the Ukraine. And it was the standout sector, like the returns were phenomenal. And of course, ESG investors typically won't hold fossil fuels, or will be severely underweight them. And so as a result, it's not surprising. We had seen up until last year, ESG investing keeping up with the broader market. And in fact, had some fantastic tailwinds because the tech sector, which they tend to overweight into, had done extraordinarily well in the last few years. And so, ESG investing had been delivering both, a values component, like investing in great, sustainable, companies that are doing the right thing for the planet, and also producing fabulous returns. But, that really became a lot more challenging in the last 12 months. But the great thing is, it is a point in time, and I do think over the long term, you've got to look at the long term and see, well, what is the overarching theme here? And the overarching theme is, we are moving to a more sustainable world, and the risk of having fossil fuel assets that become stranded, that are worth nothing, is a genuine risk that investors need to consider. But you can have, it's not necessarily a straight line. You can have these anomalies, and so definitely that can shake the confidence. But on that, we look at flows on a quarterly basis, and what we find is when there are, tough market conditions, we'll see that money will flow out of the broad market and can flow out in really substantial, chunks as well, as investors retreat because they get their confidence knocked. But we definitely see, yes, there is an impact on sustainable investing as well, in terms of maybe we don't see the same weight of money going into sustainable strategies when market conditions are tough. But what we do see is resilience. And we don't see that flow. We don't see money flowing out. We might just see a little less money flowing in. But overall, we're seeing positive net flows quarter by quarter by quarter. And we don't see that in the broader market. We see, we can see some really significant outflows, particularly in tough market conditions. So I think that that's a really interesting dynamic as well. And I've done a lot of thinking about, well, why is that? And I think of it in terms of my own perspective. I'm invested aligned to my values. Performance matters absolutely, but I'm also a patient investor, and I can see that I'm invested appropriately for the long term, and so I can manage these short-term ebbs and flows.
Yeah, it's a really good point about the fossil fuels longer term. Like if you're not going to believe that they're going to succeed longer term, then why focus on their short-term gains if you're missing out on that? So it's a really good point to highlight.
It goes back to that long-term investing that you were just talking about, right? Like we're all about that on this show, as you can tell.
Yeah. Can we talk a little bit about positive versus negative ESG screens and what that means for investors? I know a lot of people are surprised by some of the companies that actually end up in ESG ETFs.
Yeah. So negative tends to be things like controversial weapons, tobacco, alcohol.
So negative is taking things out of the fund, like completely screening them
and
out.
so you won't invest into them, or you will lower the weight that you will invest into some of these particular.
Yeah, lowering the weight bit is interesting because I would assume it's just taken out completely rather than just lowering it. That's interesting.
No, there's all different ways. And so the other thing that you can look at is contribution to revenue. And so what you'll find is that perhaps some of the ESG investments will have exposures to, say, fossil fuel, but they'll say any fossil fuel company that has, 5% of revenue attributed to fossil fuel production, we won't invest into. So, so it does mean that there can be some exposures, I suppose. So that whole revenue component, and that can, that percentage can differ between funds as well. So something to just, again, the devil's in the detail. It's a super nuanced space. You do need to actually do your research and understand what it is the particular ETF you're investing into is looking to achieve. So that's the sort of negative screen where you're basically down weighting or not holding particular industries or companies that don't meet your criteria. And then the positive weights are going into companies that are doing things that you think are revolutionary and are actually positive. And so you might then overweight quite substantially to those particular, it could be industry or specific companies. Then there's another approach where you can actually look at best of breed. So you want to have, maybe you're looking at, I'll have all the industries covered so that I've got diversification at an industry level, but I'm just going to pick out the best 2 or 3 in that industry and invest into them. And I'm picking out the best based on the ESG intentions, capabilities, as well as their financial metrics. And so it's really interesting. There's a whole school of, there's a whole debate around, do you divest in fossil fuel companies altogether, or do you invest and try and make a positive impact? And you sort of look at what happened with AGL and Mike Cannon-Brookes, and he came in and he invested and he basically forced the company to change its stance on its, coal production. And he was able to, change the board composition and to make the company get really serious about, their greenhouse gas emissions and, having a renewable energy strategy so that they can transition to, the future state. And the original plan was they were going to just ring fence those sort of dirty, polluting assets and sell them off. And he's like, well, that's not going to solve the problem. So this is this whole divest versus sort of, engage is a really important component of ESG investing. And before I really got into this space, if you'd said to me, hey, would you have a fossil fuel company in an ESG portfolio? I'd be like, hell no. But actually, you can make a big difference by holding them and then, holding them to account and, and making them take action versus if you divest, you've got no voice. To me, that's the last rung in the strategy. Like if you've tried everything to sort of influence and you can't influence, then sure, I think at that point you've got to divest. But it's a long road too. It can take many years to make those changes. But I do think it's important.
It is hard, right? Like when you're coming up with your strategy, what do you do? Do you not want to hold them because you don't want to support them? Do you hold them and, make a change? Are you more heavily weighted in areas such as, if you believe in renewables, batteries, et cetera, those industries. So you hold more of that. It can be quite overwhelming when you're trying to figure out your own strategy. And what's ethical to you may be different to me. You may be more focused on sustainability, whereas I'm more focused on governance. And how does that work? Tash and I were discussing before, is Amazon ethical? Erica, what do you think?
Look, that's a really great question. And I must admit, I've asked some fund managers, why are you holding Amazon in your portfolio? You're an ESG manager. Like, this is an ESG strategy. Why? Why are you holding Amazon? It makes no sense to me. But I've done a little bit of work on Amazon because it kept cropping up. Like, I kept on seeing it in ESG portfolios. And it is actually the 8th most held stock in international equity portfolios.
Oh, wow.
So from an ESG perspective. So ESG international equity
crazy,
portfolios. Yeah. And then when I look across all ESG holdings, so, diversified, as well as, equity, strategies, it's the 23rd most held stock. So it's a pretty significant holding in a lot of ESG strategies. And so, I've asked the question, you sort of look at it and there's so many issues around business capital, business ethics, data privacy and security. There's a lot of notable ESG issues. There's a formal antitrust, litigation going on at the moment, backed by the EU. Amazon has, allegedly been involved in anti-competitive behaviour. There's lots of allegations about poor working conditions, particularly for the warehouse workers. And, there's been also allegations of systemic occupational health and safety issues. So it doesn't sound great.
The list goes on.
The list goes on. It's not one that, rates pretty high. Like, it doesn't rate very highly from our perspective. It rates below average from an ESG perspective because of all these issues. But, they are doing some positive things. And this is where it gets really nuanced. Like, where do you focus your attention? And, I think you do have to look at it holistically. But, I think they're well ahead of their renewable energy targets. So, you can,
I didn't know that
kind
fact.
of, go, well, that's great. And we really care about the environment. And so we're not going to worry so much about all these labour force issues, all these governance issues relating to business ethics. But, we're looking to, invest in companies that are doing positive things to the environment, and they tick that box. So this is where it gets super nuanced in terms of, well, what is it we're trying to achieve here? And then I did have one fund manager, which I thought was really interesting. I said, so you've got Amazon, you're an ESG, this is an ESG strategy. Why have you got Amazon? And they said, well, during the pandemic, they employed a lot of people. We think that's great.
Okay. Doesn't matter about the conditions. They just employed them.
Really
great.
Yeah.
Wow.
Sure, I think that's what's called a long bow.
Oh, yeah.
It's really important to have all these conversations, because when you're looking into something like, I know the Vanguard Ethically Conscious International Shares Fund, they hold Amazon as one of their holdings. And going back to like the positive and negative screen, like if they've done their job and they've screened out gambling, tobacco, alcohol and stuff like that, then of course Amazon would fit under that. And just being aware of what the fund is actually looking at is really important.
I was going to say, like Erica said, there's a lot of tech companies also that fall under the ESG. And again, there's questions
like
around
Facebook.
Around the ethics around that, Apple, right? And so it is a challenge. I think one of the things I often think about is like how am I functioning as a consumer? Like where am I spending my money is also a different way of thinking about investing ethically. Like where I spend my money is part of the profits, which goes back to the shareholders. And it's like a big loop that you sometimes need to consider as well.
Yeah, I think it's like I kind of get stuck as well. Like when you're like, I know when a lot of people go vegan, for example, it's like you have to be all or nothing. And I think ESG investing gets a little bit like that, where you can't, if you're not the perfect ethical investor, then why kind of bother? But there's so many bits to this conversation and you can try and do your best, but it's really hard to be completely ethical because it's different to everyone.
Tash, are you saying you can be plant-based but also have bacon on the side?
No, I feel like you can be more vegan, but I feel like it's like the mentality for everything. Like when you're trying to start like a new exercise thing, you're like all or nothing. I'm going to exercise every single day, or if I ruin it one day, I'm not going to bother at all. And that kind of applies to a lot of things, I think. But no, you can eat a little bit of bacon if you're mostly vegan.
Yeah, and I love it. I think that the great thing is that there's just been so many new products launched to market. So we're just seeing more and more ETFs come onto the market, and it's becoming more and more tailored to individual sort of values. So you can more than ever, I think you can find something that does meet your values. And you're right, everyone's values will be different. And so for some people, just, negatively screening a few things that they're not comfortable with is enough, and that's at the lower end of the spectrum. But for others, it's like, no, making a positive impact is really important. And so, I don't want to, I want to be investing in, renewable energy, for example. I don't want any fossil fuel. Well, that's fine. There's strategies that cater to that as well. So, there is it's becoming easier to find something that will match your values.
Yeah. Do you think it actually makes a big difference in the world? Like, if we invest in our ESG ETFs, are we helping? Are we doing anything? Are we just trying to do our thing?
Or just paying more fees and feeling better?
Yeah.
Honestly, I guess I'm super conflicted because I do truly believe that we are. And I do think that because what's happening is we are seeing the weight of money moving into this space, and we're seeing that investors are asking companies more and more about their ESG policies. And so we're seeing more and more companies actually reporting on their ESG capabilities. And to be internationally competitive, they need to. We can see what's happening from a government perspective and a legislative perspective, that it's going to become a requirement. It's just a matter of time. It's it's well underway that they will need to report on these issues. And certainly from an ASX perspective, Australian Stock Exchange perspective, there is an encouragement, it's voluntary for companies to report on their climate risks, and particularly in that top 100 companies from a market capitalisation perspective, so the larger companies, I think it's more than 70% are doing that, even though there's no legal requirement to do so, because they want to attract the capital, and to attract the capital, they have to be giving this information because it's the end investors that actually are asking for this. And so I do think by us putting our money where our values are is absolutely having an impact on the way companies think about things.
So for someone who's looking to invest in ESGs, like, what is the number one top tip that you would suggest for them to do? I
think it is work out what it is that matters to you, and then really be, clear about the strategies, objectives, and making sure that it matches what matters to you. So you can't take things on face value. You need to, look at the objectives and look at how the fund manager is managing the strategy, just to avoid any buyer's regret.
But what if it's too hard? It's so overwhelming. Analysis paralysis. Just tell me what to invest in.
Which ETF?
And then I guess you're looking at a broad-based, diversified offer that from a well-known manager that has good size and good liquidity.
Yeah, we kind of said that before. You were saying the trading volume, the fees, those kind of things to look out for. Yeah.
Yeah, definitely.
Can we touch on greenwashing a little bit more as well? Sure. So kind of briefly mentioned it in terms of Vanguard, but what should people actually be looking out for to avoid it? What are the red flags?
Yeah, so look, greenwashing is really interesting. So just to sort of clarify, greenwashing is when companies overstate their green credentials. And the temptation to do that is really high because we are seeing the flow of money going into green strategies. So everybody wants to sort of tell you how great they are from
a green label on it, I've kind of seen.
Yeah, we're taking, these environmental, social and governance issues really seriously. So, and greenwashing can also mean, or capture sort of, I guess, a mismatch between expectations as well. So sometimes the company's been really upfront about what their green capabilities are, but the investor didn't quite understand what it was that they were looking to deliver. So, that's also another case of greenwashing. And really why it matters is because, if you're actually wanting to invest, in a green manner, or aligned to ESG principles, it's not great if then you're investing something that is actually not delivering to those principles. So this whole allocation of capital is what really matters to the regulators, and so as a result, greenwashing is the highest priority, or amongst the highest priorities for ASIC and for the ACCC. So both regulators have said we are looking at this really closely, and that's why we're starting to see some of these issues come to the forefront. So So Vanguard was one, Mercer Superannuation is another, but ASIC have said that they've got quite a number of other funds that they're closely looking at. So I think that there will be more to come. And as a result of that, we have seen, which I think is fantastic, right? Because, how do you pick greenwashing? How do you sort of combat it? It's hard, right? Other than, you've got to do your own research. And as you said, the analysis by paralysis, and it's a little bit boring and it's a little bit dull as much as it's important. So, if the regulators can step in and hold the industry to account, I think that's actually really positive, because what I have definitely found as a researcher is that the fund managers that I talk to are now being much more cautious about their green claims. And whilst, I'm thinking of one fund manager as an example, nothing has changed. They're still doing everything they said they were going to, but they're really watering down the claims, even though nothing has changed in the way that they approach investing, just for the avoidance of doubt. They're being extra conservative, extra cautious. And I think, as a result of this, scrutiny by regulators, it's great for investors, because there should be more confidence going forward that the green claims are genuine, because if they're not, the fund managers are going to be caught out. And it's reputational risk, like we're talking today, Vanguard, Mercer, their names are now associated with sort of greenwashing allegations. That's not great. You don't want that. That's not a positive thing.
Especially for Vanguard as well, because they're kind of the gold standard for passive ETFs, I guess. So hearing greenwashing with them isn't the best for everyone.
Yeah. Such great information. If someone wants to learn more about ESG investing, where do they go? Where can they learn more?
Yeah, okay. So I think the Australian government's got a website, MoneySmart, so that's pretty good. So, nice impartial information about various topics, including ESG. I think there's heaps, Google, there's heaps of information available through Google. Obviously, there's a lot of, researchers like Morningstar that undertakes a lot of ESG research. But, I'm finding it more in the mainstream media as well. Like, there's just so much information because there is such interest in this space. So I don't think it's hard to actually find, information as an investor in relation to ESG.
There's just so much information out there. But I think, Google MoneySmart, check out Morningstar, see some of Erica's articles. I'm sure you've written something interesting. And I think for me, when I'm looking at ESG things, is actually just looking at the holdings as well, like going into each ETF and being like, what are their top 10 holdings, and being mildly shocked by it.
Do I feel comfortable with Amazon?
Yeah. Why does this look like the A200 anyway? Like, what's the difference here? Yeah.
It's a really good point.
Beautiful. Well, thank you so much, Erica. Great to have you on the show.
Yeah, this is great. Yeah, thanks for sharing everything with us. This was awesome.
Pleasure. So nice to meet you both, and love the discussion.
Thank you.
Thanks, Erica. Cheers. Bye. Thanks so much for joining us in this episode. If you found it helpful, feel free to leave us a rating or review, or share with a friend. Make sure to follow us on social at Get Rich Slow Club, or you can follow Tash at Tash Invests, or me at Ana Kresina.
This show was brought to you by Natasha Etschmann, who is an authorised representative, 1299881, of Guideway Financial Services, AFSL 420367, and Perla, who is an authorised representative, 1281540, of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.